From payments to lending, today's tech startups are said to be sounding the death knell of banking. But recent issues at Lending Club in the US highlight that fintechs might be running a little bit too fast and their controls can't keep up. Dermine is a professor of banking and finance at INSEAD, and he's also the program director of executive development programs, strategic management in banking and risk management in banking. He joins us now on INSEAD Knowledge. Jean, thanks for being here.
Thank you for the invitation.
My first question, Jean, is coming amid so much hype at the moment around the future of fintech. What does the recent issue at Lending Club tell us about the state of the industry and its growth trajectory?
Yeah, so Lending Club received a lot of visibility recently because its CEO, the founder, the French Monsieur Laplanche, was fired by the board. The Lending Club is important because it is one of the larger peer-to-peer lenders in America. When it went to an IPO in December 14, it received tremendous visibility because it has on its board very prestigious person like John Mack, who was former CEO of Morgan Stanley. There's Larry Summers, the former US Treasury Secretary. There's even an INSEAD alumnus, Simon William, who was on the MBA program and one of my students many years ago. So first, for Lending Club, one should separate the very recent event with the dismissal of the CEO, which is very special because it is due to mis-selling loans to one hedge funds in New York, from what was already happening to the industry in general, which has been a lack of funding. So there's a big demand for loans from these fintech companies. And at first, the fintechs were financed by individuals. That's why it was called peer-to-peer lending. And increasingly, because of a lack of funds, they've started to borrow from institutional investors like pension funds, hedge funds. And already since the last 6 months, these institutional investors have been pouring less and less money into these fintech companies. That's why in fact, the share price of Lending Club was already going down for several months.
And do you think it's possible for marketplace lending to succeed in light of this?
So I always believe personally that the hype is too strong for these fintech companies. Banks have been there for 600 years, and there's been a very special reason as to why banks exist. They provide very, very specialized services. And it's not totally clear that these fintech digital lenders can cover the full spectrum of lending. So I do believe that for some loans, in particular extremely safe loans, that the peer-to-peer lending or marketplace funding will be very, very efficient. But as soon as credit risks start to be larger, then I do believe that balance sheet funding by banks will remain always important.
And you pointed this out in a recent paper of yours. This isn't the first time the banking industry has been disrupted. Is this merely déjà vu, do you think, the fintechs?
For the past 30 years, I've seen this hype about disruption coming. Years ago, there was telephone banking and the fear that banks would disappear, that telephone companies would take over. Around 2000, there was internet banking, Microsoft will come in and banks would disappear. That has not happened. So today we have smartphone technology, digital banking, and therefore I'm pretty convinced that, as has been the case in the past, the banking industry will adapt to the new technology.
Mm-hmm. And in your article, you describe the 6 main functions of banking. Is there a particular service that looks more vulnerable to disruption and perhaps one that looks most resilient?
One is purely the payment service, where you debit credit accounts, or we sell shares, sell bonds. That's simply moving information from one person to a person. And that, of course, purely data processing, I can believe that other industries may be much more competent than banks in purely data processing. Therefore, not a surprise that the major entrants into the banking sector have been on the payment system, like with PayPal technology. But there are other important banking services, which is like lending, which involve credit analysis, monitoring of collateral, eventually restricting loans when there's a problem. All the business of advisory service to large corporations and risk management. Okay, this really requires analysis of data. And that's really a truly specific banking expertise. And that's an expertise that cannot easily be copied by a new entrant. And then extremely important third is that banks have a balance sheet and they perform traditional maturity transformation. They take short-term deposits, they transform that into long-term loans. And clearly, again, this service, because of the balance sheet of banks, cannot be copied by marketplace funding.
And do you think it's capable of, is the banking industry capable of disrupting itself and innovating?
So I can indeed believe that large banking organizations may not be the best place to develop technology, but what I think will happen is that you will have these fintech companies developing new technology, and then quickly the banks will link up with these new fintech companies.
And in your view, I mean, if we look at it generally, how should policymakers, do you think, how should they be responding to both the traditional banking industry and fintechs, given their current activities?
So that relates also to a question, which is whether or not these fintech companies would have any competitive advantage because they would not be regulated like the banks. So personally, I believe it's a very temporary advantage, because as soon as they get bigger, the regulators start to step in. And that is, by the way, a second reason why the share price of Lending Club was starting to go down, is because they were increasingly under the scrutiny of the US regulator. And US consumer protection is looking both at investors investing in these fintechs, whether or not they have enough information, and also looking at the issue of borrowers borrowing too much. So I do believe that it is a function indeed of regulators to look at this, and I have no doubt that they are going to come after these fintech companies as well. The fintechs now have a problem that there is not enough funding going to finance their loan portfolio, and we do start to see fintechs keeping the loans on their book. And so when they start to keep the loans on their book, basically they become a bank, and therefore they're also going to be subject to exactly the same capital regulation as the other banks.
Okay, Jean, thank you for joining us on INSEAD.
Thank you.